For decades, economists have been really scratching their heads over something called the equity premium puzzle.
Hmm.
Essentially, it's this surprisingly large difference between the returns you get from the stock market versus, much safer bets like government bonds.
Right, the risk-free rate.
Yeah,
Yeah.
exactly. And back in 1985, Mara and Prescott really shone a light on just how big this historical gap is, way bigger than standard economic models could explain back then.
It was a real puzzle
Yeah,
because, traditional thinking suggests investors should only demand a modest extra return for taking on stock market risk.
just a little bit extra.
Yeah, but the historical data showed this much juicier premium.
Mm.
It's almost like investors were demanding a far bigger reward for, enduring the market's ups and downs than our theories could really justify.
So it led to questions like, are investors just incredibly risk averse?
Or
Or
were our models just missing something fundamental about how the economy actually works?
exactly. And that brings us right to the heart of this deep dive.
Okay.
We're going to explore a pretty recent piece of research. It's titled Searching for the Equity Premium.
Ah, yes. I know the one.
And these researchers, they've taken a bit of a different tack. Instead of just focusing on, say, individual investor choices.
Which was a standard approach for a while.
Right. They've built a more comprehensive model. It's what economists call a general equilibrium production economy, trying to solve the puzzle from, well, a wider angle.
And that general equilibrium approach, it's like looking at the whole economic machine, isn't it?
Yeah, definitely.
It considers how stuff gets produced, how people find jobs, how firms invest, all those interconnected bits.
And how they influence asset prices, like stocks.
Exactly. It's a much more holistic view compared to just zooming in on investors alone.
And their specific model, it's got some really interesting ingredients. They've put in recursive utility.
Okay, let's unpack that a bit. Recursive utility.
Yeah, it's a more maybe nuanced way of thinking about how people feel about risk. Not just that they dislike uncertainty, but also when it gets resolved.
Right, the timing matters. And they also included,
Search frictions in the labor market.
which reflects the real-world hassle, basically, of companies finding workers and workers finding jobs. It's not frictionless.
No, definitely not. And crucially, they account for capital accumulation, how the economy actually grows over time, through investment in machines, tech, that sort of thing.
So the big question for this study and for us in this deep dive is how do all these pieces,
Fancy utility, the job market frictions, the
Yeah.
investment.
yeah, how do they work together in the model to actually generate an equity premium that looks like the one we've seen historically?
And can it do more? Like, can it also explain other patterns we see in finance, but also in the broader economy, the business cycle?
That's the key test, really, not just hitting one number, but seeing if the underlying mechanics make sense and match other observations.
Precisely. We want to understand the gears and levers inside the model, and this is where it gets really interesting, I think, because the research suggests this really tight link between, stock market performance and the overall health of the economy, the booms and busts.
The business cycle connection.
Yes. And it also points to some maybe surprising roles for things like how fast wages adjust or just the general dynamics of the job market.
So things you might not immediately connect to the stock market premium.
Exactly. So by the end of this, you, the listener, should have a much clearer sense of how these seemingly separate economic pieces are actually, well, deeply intertwined.
Okay, so let's get into their findings. The study reports some pretty compelling results, actually.
Yeah.
Their model, with all these features we've just discussed, it does a remarkably good job of reproducing key historical averages.
Like the premium itself.
Yes. They get an equity premium around 4.27% per year, stock market volatility about 12.42%, and an average risk-free interest rate near 1.97%.
Those numbers sound pretty close to historical benchmarks.
They are. And importantly, they get these numbers while the model economy also shows fluctuations, business cycles, that look pretty plausible compared to history.
Okay, so that's a solid starting point, right? Getting those big averages lined up.
Definitely a major hurdle cleared. But as you said, the story gets more interesting when you look under the hood a bit,
At the details.
at the details. The model also generates some intriguing patterns over the business cycle.
Like what?
Well, it suggests that the equity premium, that extra return, and the stock market volatility, they tend to be countercyclical.
Meaning they go up when the economy goes down.
Exactly. When the economy is doing poorly, uncertainty is high, investors demand a bigger reward for risk, and the market gets, well, choppier.
And the opposite in good times.
Right. During booms, the premium tends to shrink, and the market calms down a bit.
Okay, that sounds intuitive. What about other things?
Well, interestingly, the model suggests the interest rate and consumption growth are largely unpredictable, which fits some data, but maybe not perfectly, as we'll discuss.
Now, you mentioned one really crucial element earlier, wage inertia. Can you tell us more about that? What exactly is it, and why is it so important in their story?
Right, wage inertia. It's fascinating how it acts as a key mechanism in this model.
Okay.
So even though the model shows overall consumption is relatively smooth because people use investment to buffer shocks,
Right, smoothing things out.
the dividends that companies pay shareholders end up being procyclical.
Meaning they go up and down with the economy.
Yes, exactly. Dividends rise and booms, fall and bust. And the researchers argue that a primary driver for this is this wage inertia.
Okay, but how does that work? How does sticky wages lead to dividends moving with the cycle?
Well, think about it like this. Wage inertia means wages don't immediately jump up or down when worker productivity changes.
They lag behind.
They lag. So when the economy hits a rough patch, output falls, company revenues drop. But their labor costs, because wages are sticky downwards, don't fall nearly as much.
Ah, so profits get squeezed harder.
Exactly. A bigger squeeze on profits in bad times. And then the flip side, in a boom, productivity rises, but wages lag going up, so profits surge even more than output,
It's like your biggest cost item is slow to react.
amplifying the swings in profitability. Yeah.
That makes a lot of sense. It's like, yeah, trying to turn a big ship takes time. Did the study try to quantify this stickiness? Put a number on it?
They did, yes. Their model is calibrated using a wage elasticity to labor productivity of about 0.278,
Meaning?
meaning roughly for every 1% change in productivity, wages only adjust by about 0.28%.
Okay, so quite inelastic.
Relatively, yes.
Yeah.
And interestingly, they compared this to historical U.S. data going way back to 1890 up to 2015.
Yeah.
And they estimated the historical elasticity was actually quite similar, around 0.267.
Wow. Okay, so it's not just a theoretical assumption.
No, it seems to have some empirical basis, especially when you look at that long historical sweep, maybe more so than if you just look at, say, the post-war data, which sometimes shows higher elasticity.
Right, so there's historical evidence for this wage stickiness. And does the study say this stickiness is constant? Or does it change?
Ah, good point. They actually suggest it's time varying. The impact of this wage inertia becomes, well, more pronounced in bad times.
When profits are already under pressure.
Exactly. This time-varying nature is really important. It amplifies the risks investors face, especially in downturns.
Which pushes up the risk premium.
Precisely. The risk premium gets larger, particularly during those rough economic patches. And this helps explain why the equity premium, and maybe market volatility too, seems somewhat predictable. The market sort of anticipates these periods of higher risk driven by wage dynamics.
Okay, so wage inertia is a big piece, but the model also includes those labor market frictions you mentioned, the real-world difficulties in hiring. How do those fit in?
Right, the frictions. The model uses something called a matching function to capture this.
Like supply and demand for jobs, but messier.
Kind of, yeah. It's an equation that describes how unemployed workers and open job vacancies actually connect. And in the real world, it's not instant or perfect. It takes time, effort.
It's money.
Costs money, exactly. The model includes hiring costs for firms, some that scale up, some that are fixed per hire. So yeah, it's not just putting up a sign and getting the perfect worker instantly.
And how do these matching problems and costs affect the broader picture in the model?
Well, a key idea is labor market tightness. Basically, the ratio of vacancies to unemployed people.
So lots of jobs, few workers means a tight market.
Right. And when the market's tight, it gets harder, more expensive for firms to hire. Those higher hiring costs then feed into the wage determination process.
So difficulty hiring affects pay, which affects profits.
Which affects stock returns. It's all connected.
Right.
And what's really insightful, the study suggests that these labor market frictions, when you combine them with that wage inertia we talked about,
the sticky wages.
Yeah. Together, they can lead to what the paper calls endogenous disaster risks.
Endogenous meaning generated from within the model itself, not just assumed.
Exactly. The model itself generates the risk of these sudden, large, negative economic shocks. It's a finding that echoes some other work in search models, too.
Disaster risks sounds pretty dramatic. How do these potential economic catastrophes generated by the model connect back to the equity premium?
Well, in this framework, These disaster risks the possibility of, significant unexpected drops in overall consumption. They play a huge role in generating that equity premium.
Mazo.
Investors demand that higher average return on stocks, partly as compensation for bearing the risk of these rare but potentially severe economic downturns that could hammer their consumption possibilities.
It's like paying extra for insurance against a really, really bad outcome.
That's a good way to think about it, yeah.
And the researchers actually looked at history to quantify these disasters, right? Using real data.
They did. They used a method from Barrow and Ursua, looking at the biggest peak-to-trough drops in historical consumption and output data to identify these disaster events. Then they checked if the probability and size of disasters implied by their model lined up reasonably well with those historical estimates.
Grounding the model in reality.
Trying to, yes. So it's not just conjuring disasters out of thin air.
Okay, so let's loop back to predictability. You mentioned the model suggests stock returns and volatility might be somewhat predictable.
Yes, the model implies that excess stock returns the premium over the risk-free rate, and market volatility should be countercyclical and predictable to some extent.
And how would you predict them, according to the model?
They suggest using the ratio of stock prices to overall consumption, the price-to-consumption ratio.
Okay.
When that ratio is high, the model predicts lower future excess returns and lower volatility. And vice versa. Low PC ratio implies higher future returns and volatility.
Kind of like when valuations seem stretched relative to the real economy, expect lower returns ahead.
That's the intuition, yes. The market gets more cautious, demanding less premium when prices are high relative to consumption.
That countercyclical idea, it feels right, doesn't it? High uncertainty in bad times, higher required return.
It aligns well with intuition and some empirical findings.
But what about predicting other things, like consumption growth? How well does the model do there?
That's interesting. The model actually predicts that consumption growth and also the interest rate should be largely unpredictable.
Really? But don't we sometimes see patterns or predictability in consumption data?
We sometimes do, yes. This is one area where the model might diverge a bit from some empirical studies. The researchers suggest that the way investment acts as a buffer in their model.
Smoothing things out again.
Right. It smooths things so much that it dampens the predictable patterns in consumption itself. Businesses adjust investment, which cushions the blow to household spending patterns, making them look less predictable.
I see. So the economy's ability to invest makes individual spending harder to forecast. That's a neat insight.
It is.
Now, the study also does something else quite interesting. It breaks down the overall stock market return into two parts. The return from investing in physical capital factories, machines, and the return from, well, investing in hiring labor. That seems like a novel decomposition.
It's a really interesting way to think about it, yeah. The total stock return is like a weighted average of the return on physical assets and the return on, effectively, the workforce.
Okay. So what did they find?
Well, here's the surprise. Even though labor's share of output is huge, they calibrate it around 74.6%.
Massive.
The share of the stock return that comes from this hiring return component is actually really small, only about 7.4% on average in their model.
Wait, that is surprising. Labor is most of the economy, but its associated return is tiny fraction of the stock return. Why?
The intuition relates to how stocks are valued. A stock's price reflects the present value of expected future profits or dividends.
Okay.
And wages are a major cost that reduces those profits. So even though labor is essential for production, its impact on the stock price is largely filtered through its effect as a cost, subtracting from the dividends investors expect.
So the market value is tied more to the profits after paying wages.
Exactly. It's weighted towards the return on the capital that generates those net profits.
Got it. That makes sense now. And what about the characteristics of those two return streams, the capital return versus the hiring return?
Well, the model shows the hiring return actually has a much higher average return and is much more volatile than the return on physical investment.
Higher mean higher volatility for the hiring part.
Yes. But because its value weight in the total stock return is so small, that 7.4% number,
Right.
its large mean and volatility don't actually move the needle much on the overall stock market's average return or volatility. The investment return component dominates the overall characteristics because it has almost 93% of the weight.
So labor market dynamics are crucial, but their direct impact on overall stock return stats is maybe less than you'd think, channeled more through the capital side.
That seems to be the implication of their decomposition, yes.
Okay, we've covered a lot on asset prices, business cycles, but the study also calculated the welfare cost of business cycles, how much these fluctuations actually hurt us. What did they find there?
This was a particularly striking result, I thought. The model estimates a really substantial welfare cost of these cycles, around 33.6%.
33.6%, that sounds huge.
It is huge, especially when you compare it to, say, a classic estimate by Robert Lucas back in 2003, which was based on a simpler model with standard log utility. His estimate was tiny, like 0.05%.
Wow, okay. So 33.6% implies people in this model world would give up over a third of their lifetime consumption just to get rid of business cycles.
That's the interpretation, yes. It's a staggering number. It really highlights how painful economic instability, especially those disaster risk scenarios we talked about, could potentially be.
What drives such a massive difference compared to the older estimates? Why is the cost so high in this model?
A few key things. One is that recursive utility framework, again. It captures not just a dislike for risk, but also a dislike for uncertainty about when bad shocks might hit.
The timing aversion.
Right. And second, the presence of those endogenous disasters risks the possibility of really large, sudden drops in consumption that contributes massively to this high welfare cost. The small chance of a really bad outcome has a big impact on welfare.
And this cost isn't constant either, right? It depends on the state of the economy.
Exactly. They find the welfare cost is countercyclical. It's even higher during downturns when things are already bad.
Kicking you when you're down.
Sort of, yeah. And they also see a long right tail in the cost distribution, meaning some really severe contractions can impose exceptionally high welfare costs.
Which really underlines the potential value of policies aimed at mitigating those big downturns, those disaster risks.
Absolutely.
Yeah.
Especially policies that might stabilize things during those particularly vulnerable periods.
Okay, one last intriguing tidbit from the study that caught my eye, something about the equity term structure. Can you briefly explain that and what the model said?
Sure. The equity term structure looks at the risk and expected return of dividends expected at different points of the future. Like, are near-term dividends riskier than far-off ones?
Okay, and the model's prediction?
It predicts a downward-sloping equity term structure,
Meaning
that dividend payments expected in the near future are seen as riskier and thus have higher risk premiums compared to dividends expected further down the road.
why would that be?
The intuition is that those near-term dividends are more exposed to the immediate threat of those potential economic disasters we discussed. The further out you go, the more chance things might smooth out or recover.
Interesting. Near-term cash flow is riskier.
In their model, yes, due to the timing of disaster risk.
And finally, the study had a really thought-provoking point about the data itself, questioning whether the post-World War II U.S. experience is, well, typical.
Right. They ran simulations from their model over long periods, and their results suggest that the specific combination we saw in the U.S. post-war, relatively high equity premium, but also relatively stable low volatility consumption, might actually be somewhat unusual.
An anomaly, perhaps.
Possibly, yeah. Compared to the wider range of outcomes the model can generate over the long haul, it implies we should be cautious about drawing universal conclusions only from the last, say, 70 years of data. It might not be fully representative of the deeper economic forces.
That's a really important methodological point. So, okay, let's try to bring this all together. This deep dive into searching for the equity premium, it seems to offer a really promising framework, doesn't it?
I think so. It connects the dots between wage stickiness, labor market frictions, capital accumulation, and that long-standing equity premium puzzle.
Yeah, and what really stands out is how critical those maybe less obvious factors like wage dynamics and labor market conditions seem to be for shaping asset prices.
It's a connection that's often understated, I think.
And the model doesn't just get the average premium, but also generates those countercyclical risk premiums, the volatility patterns.
And it highlights those potentially huge welfare costs of business cycle swings, especially the really sharp downturns.
So the takeaway for you, the listener, well, thinking about that potentially massive welfare cost, it really makes you wonder what kinds of economic policies could be most effective. How can we smooth out the ride and protect ourselves from those big economic risks, particularly the ones tied to jobs and wages?
It definitely opens up avenues for more research. Like, how would these mechanisms play out in the kind of new Keynesian models policymakers often use? Would it change our view on monetary or fiscal policy?
Or what about applying it globally or to different kinds of firms?
Lots of interesting directions to go. how different labor market institutions across countries might interact with these mechanisms, for example.
Definitely plenty to mull over. Well, thanks for taking this deep dive with us into some pretty complex, but I think really insightful research.
My pleasure. It's a fascinating area.
Until our next exploration.